Hello and welcome to the DSP BlackRock Fund Manager series. We're here with Rohit Singhania today to discuss the DSP BlackRock Tax Saver Fund. Rohit, thanks very much for being here. As we know, the Tax Saver Fund was incorporated in Jan 2007. It's a 9-year-old fund today with a corpus of about 1,360 crore rupees. You've been managing it since June 2015, is that right? Okay. So tell us, Rohit, this is an equity-linked savings scheme whereby investors can invest 1.5 lakh per year to avail of a tax deduction under Section 80C of the Income Tax Act of 1961. This also means that there's a 3-year lock-in period for this fund. How does that impact your investment decisions? How do you then define the objective of this fund given that there's a lock-in period of 3 years?
Right. So, to start with the objective of the fund, right, it is to generate capital appreciation over a longer period of time. As far as the portfolio construct and the 3-year lock-in aspect goes, I think when today I'm buying a stock or trying to identify a stock, the key attributes would remain same across any funds. For example, if today I'm evaluating a company, I would look at the cash flows for next few years, how the ROE expansion is going to happen. If it's in a small cap space, how the market share gain is going to happen, what has been the history of the business, how it has grown. So these will determine my stock selection. What happens is, I know it's a 3-year lock-in, but looking at the market and the volatility we may see sometimes, so it may not be always correct for a fund manager like me, to keep on holding to your stocks or stock weights. So yes, though I have a 3-year money, if at times I would feel, okay, this stock has done its bit right now, maybe I need to reduce its weight or move out of it, I would do that to favor my investors, who invest with me. That's how the process of stock selection. And the 3-year is there in back of my mind, but it doesn't govern me, in terms of taking and buying a stock and saying, okay, I'm going to have a look at it after a longer period of time.
So would you say that you take a longer term horizon and have a buy and hold strategy, or would you say that you manage it like how any other diversified equity fund would be?
So if you look at a tax saver fund, you may find the same names over a longer period of time. But what may change at a given point of time would be the percentage holding at a particular point of time. So I may be bullish on a business or a company for the next 5 years, but that doesn't mean I would have a similar weight in all the kind of market environment in it. So I would have a core holding, but I would increase and decrease my weightage depending upon how I feel the next 6 or 12 months may perform in that particular industry or sector, or in case a company specific issue.
Okay, and so can you define the market capitalization breakup for this fund, and also how you're currently positioned in terms of market capitalization?
So how we internally define market capitalization manner is, when you look at the top 100 companies, which we call as a large cap, we define it by the market cap today. So number 1 market cap company and the number 100 market cap company today is large cap for us. 101 to 200 is mid cap. 201 to 300 is small cap. And anything below top 300 we define as a micro cap. If you see the tax fund today, I think the large cap proportion is about 68.5%. And the balance is into mid, small and micro cap companies. That's how it's positioned.
We've also seen the markets have rallied quite significantly in the last 6 months post-budget. Different sectors have performed well in different points in time. Not all sectors really perform together. The whole market doesn't necessarily always rally together. Can you tell us in this fund, in the Tax Saver Fund, how are you currently positioned in terms of sectors? Where are you overweight? Where are you underweight? And how your positioning looks?
Right. If you look at the positioning today, we are overweight on financials, on the healthcare sector, industrials and materials. Our underweights would be consumer staples, IT and telecom. And if you see the construct of the portfolio for the past few months, it's remained what is it today.
Lastly, Rohit, is there any advice you would like to give to investors given where we are in the markets today and how your fund is currently positioned?
So, what I have seen is, in this tax saver category, and even for our tax saver fund, most of our inflows usually tend to come in the last 3 or 4 months of the financial year, right? And when you talk to the same investor and you talk to him about the other investments and the diversified equity funds, they talk about SIPs, which I think it's a great to invest into equity markets. Whereas in tax saver, it's almost most of the time lump sum. So I would really advise investors is, how to look at SIP in a diversified equity fund. They should look in this tax category also in a similar way.
Great. Thank you very much for joining us, Rohit. Appreciate you spending time talking about the Tax Saver Fund.
Thank you.
And thank you very much for joining us for the DSP BlackRock Fund Manager interview series. Goodbye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.